In the private equity world, we frequently see businesses that have successfully grown via acquisition. But when you peel back the onion and look at the underlying individual businesses, they may be flat, or in some cases even on decline. Acquisitions can create the illusion of top-line growth, but is it realistic to get credit for that growth if the underlying operations aren't growing organically?
We did the NASDAQ listing for a company called Wipro, which is an Indian company that does a lot of IT services. Wipro's initial business, which came about in World War II, was selling cooking oil. So if you still looked at their financials, there's a division that they sell a couple $1 million worth of cooking oil. So if they had been left to their own devices and said, well, we're just going to be a cooking oil company, they would have ended up nowhere. So there are always instances where, you know, sort of your core business, who knows how they expanded into IT services, but the core business of Wipro had to expand beyond cooking oil because they were going to do something else. IBM used to sell almost exclusively hardware. What people don't realize is that the hardware actually was made to work by software. So until Microsoft passed it, IBM was one of the largest software salespeople. And it continues to sell software. So the idea that you have to stay to your core business in the marketplace it shouldn't give you value for growing, that's nonsense. Of course they're going to give you value for growing because the growth is, what's your revenue size, how profitable are you, and what's your cash flow do you generate? The market will determine whether they're going to give you credit for whether you did it through acquisition or whether you did it through organically. And I think the market generally gives credit to growth, to top line and cash flow, and they don't care how you got there.
The question is faulty, of course, because we're not talking about credit, we're talking about money. You have to be a fool to say it's good that constituent parts of the company don't grow or flat or are falling down, whether you're on an organic track or whether you're on an acquisition track. The point of the matter is that if you're larger and have a bigger base, you're likely to be able to weather downturns and weaknesses in your constituent parts a bit better. You're liable to be larger, and if you have to bail, command a better price. So I don't think it's a matter of whether you get you lose credit when you do an acquisition and things are going badly. I just think you end up in a better bottom line space, bearing in mind that it's not the place that anyone should aspire to be, regardless of strategy.
We represented a seller several years back who was in the construction industry, in the materials business. And Drew took his business as far as he could with the resources, access to capital, staffing that he had, his know-how, and he was a very sharp guy. So he conducted a recap, and that recap took out 80% of his equity, and he rolled 20%. The buyer was a private equity firm, and together with the knowledge and the resources of the private equity firm and the knowledge of the industry that Drew had, they were able to, one, grow his former business organically, and two, conduct 5 or 6 acquisitions. Originally, Drew went laughing all the way to the bank. He came out in the teens, and it was more money than he ever dreamed of. The 20% that he could not access on his own gave him 3 times as much as that 80% because of the combination. So when we concern ourselves about bottom line, it requires the right skill sets to be in the organization, and if you don't have them, you got to get them.
The way businesses grow and the way you acquire them is always that, in a way that you're going to know what you can do with it, or understand what you want to do with it prior to acquiring it, so that you know going in what the plan is. But it is built on people. It's built on good, strong banking relationships, and to completely understand how and why you're buying it and how well that fits within your existing organization. You need buy-in by everybody in order to do it. But once you get there, and you begin to see the change and you begin to see the growth, I haven't found personally anything more exciting. So it's very, very satisfying to watch happen when you do it.
You know, we have a saying in the banking industry and among lenders that the deal going in is not the deal going out. So it may look rosy on the inside, but by the time you get in there, things change. And I appreciate the input from the acquisition team, because if you do have everything set in place and you understand what you're getting into, then it is a great way to go. But again, I just reinforce the idea about what it looks like post-merger, post-acquisition. Do you have the team? Do you have the resources? Do you have the cash? Do you have the morale? Do you have the employees on board? Do you have the customers on board? A lot of things, a lot of risk. And we talked about this at the very beginning with Rudy, volatility in the market. And just be cautious of that. You know, it sounds great, and certainly there have been some positive acquisitions, but again, deal going in is not the deal going out.
It's a question that answers itself. I mean, would you rather own 100% of something worth $50 million or 20% of something worth $1 billion? But having said that, you ask a more interesting question in terms of debt versus equity. My position is that as a risk profile of a company, if it's a very risky company, you'll find that the cost of debt, because it'll include debt, it'll include tranches of warrants, it'll include a lot of other sort of interesting permutations. The cost of debt in a high-risk company should equal the cost of equity, because you haven't, the risk profile is the same in either case, whether they characterize it as debt or not.
Usually it's more. It's end up costing more.
Well, the problem with debt is I think it was Michael Jensen out of HBS that said debt imposes discipline, and I think that's exactly what it does, particularly if it's a coupon that you have to pay off. It'll impose a discipline on you that could be a stranglehold if there's a downturn in the industry. If it's participating, you'll end up giving up more to your company through a debt instrument than equity. At least equity stops at some point. You know, I'm going to buy 20% of your company for $3 million. That $3 million note, with all the caveats and with the other aspects, may end up costing you more if you hit a rough patch.
I'm not in favor of minority recaps, where you get a less than 50% investment in your company. That piece tends to be discounted because it's a minority interest. And then when you sell the majority piece, say 51%, who are you going to sell it to? In many instances, and with all due respect to my private equity friends in the audience, what happens is these groups embed themselves in the capital structure. And so depending on what they want will impact what you can do. Majority recaps.